Hey guys, it's Aman
And Christina
from Our Rich Journey. If you ever wanted to invest in index funds for financial independence, this video is for you. Because in this video, Christina and I are talking everything about index fund investing. And if you know our story, you know that Christina and I are index fund millionaires. And so on this video, we want to give you guys some insight into investing in index funds for financial independence.
But first, if you are new to our channel is all about saving money, making money, and investing money on the road to financial independence. Aman and I pursued financial independence for 8 years. We reached our goal and we quit our jobs and retired before the age of 40. So if you are interested in learning more about saving, making, or investing money, make sure you subscribe to our channel and follow us on Instagram. So because this video is about index funds, let's first start off by defining what an index fund is. So an index fund is a group of stocks or bonds that are designed to track the performance of a particular index. So I'll give you an example. The S&P 500 is an index. It is made up of the top 500 US companies on the stock market. If you have an S&P 500 index fund, that means that index invests in all of those 500 companies that make up the S&P 500. So if you own an S&P 500 index fund, you're investing in those 500 largest US companies.
So there's one thing that we must clarify when we are defining index funds, because you will often hear the term mutual fund used for index funds. Well, an index fund is a mutual fund, but it is a subcategory of mutual funds. There are really two types of mutual funds. There are index funds and there are actively managed mutual funds. There's a huge difference when it comes to the overall makeup of these two types of mutual funds. Index funds track an index. Actively managed mutual funds are ran by a mutual fund manager. An individual makes the decisions on what goes in and out of an actively managed mutual fund. This is a very important point that we're going to touch on later on in this video, but it's something that we want to highlight right now. So that is the definition of an index fund. Now that you know that, let's talk about the top 10 things you should know before investing in index funds. The first thing is that index funds are a great way to diversify your investment. If you have a little bit of money and you want to invest it in the stock market, starting with index funds is a great way because it gives you automatic diversification. Let's say you only have $100 to invest. You may only be able to buy 1 or 2 individual stocks. On the other hand, if you take that same $100 and you invest it in an index fund, you can own hundreds of companies within that index fund.
So the next thing to keep in mind about index funds is that there are so many different index funds to invest in. Now, people typically hear of the common index funds, like a total stock market index fund or the S&P 500 index fund. That's just 2 examples. There are literally thousands of different index funds that you can invest in. So you really have to understand what your goal is when you're investing with the index funds and choose the one that aligns best with your goals.
And I think this is a great point because oftentimes when people think of index funds, they think that they are boring vanilla investments, when in fact you can invest in index funds that track very specific sectors like technology, like healthcare, areas that you may be interested in. So maybe you're not investing in an individual stock of a medical company, but you can invest in an index fund that tracks all of the medical companies. I bring this up because there is a lot of flexibility when it comes to investing in index funds when you are building your overall portfolio. The next point we want to raise is don't believe the actively managed mutual fund hype. And I say this because when you go about picking a mutual fund, you may be making that decision between an index fund or an actively managed mutual fund. And when you see an actively managed mutual fund, you will see a lot of bells and whistles behind that type of fund. They'll talk about the fund manager. They'll talk about all the resources that go into this actively managed mutual fund to make it seem as if because this thing is active, because they're trading stocks almost every single day within this fund, that it is somehow better than just a regular old index fund. Well, history has shown us that when you just pick the index fund over the actively managed mutual fund, that index fund performs better. And this is the case for many reasons, but one of the big reasons is because actively managed mutual funds tend to not be consistent winners when it comes to picking the investments within that fund. The other issue is that actively managed mutual funds, they have higher fees than index funds. So the fact that the actively managed mutual fund has a fund manager that can't consistently pick winning stocks combined with the higher fees results in lower performance than just the index fund.
So because Aman mentioned fees, this leads to our next point, which is to always be aware of fees associated with investing in index funds. And to check out that fee, the first thing you want to look at are expense ratios. These fees can vary depending on the brokerage company that you invest in. And I'll give you an example. There's an S&P 500 index fund that is offered by Wells Fargo, and the expense ratio associated with that is 0.45%. Now you can go to Vanguard and find an S&P 500 index fund that is investing in those same companies, and the expense ratio for that is only 0.04%. That is 10 times less to own the same index fund with Vanguard as compared to with Wells Fargo.
Our next point is that some index funds require a minimum investment in order to get started investing in that fund. Now, once you get over that initial minimum investment, then you can add any dollar amount you want to into that index fund and keep on investing. But sometimes that minimum can be a discouraging part about just getting started. And we just talked about Vanguard because Vanguard has some of the highest minimum investments to get started investing in their index funds. But there are other companies that allow you to get started investing in their index funds with no minimum. In fact, Fidelity has a ton of index funds that allow this.
Another thing to keep in mind is that many brokerage companies have an ETF equivalent to their index funds. Now, we're not going to go into detail about the difference between an index fund and an ETF. There are a lot of similarities with it, but we did a video on the differences, so we'll leave a link in the description below. But that's something to keep in mind, that if you're looking for a particular index fund and you may not have the minimum investment for an index fund, you should check to see if they have an ETF equivalent. And I'll give you an example going back to Vanguard. If you're searching through Vanguard's index funds, on their site, once you identify a particular index fund that you're interested in, if there is an ETF equivalent, it will be on that same page and you can click on it to find the ETF equivalent.
We bring this up because if you are all set on investing at a particular brokerage company, but you can't afford the minimum investment for their index funds, you can always buy the ETF equivalent, which is usually much lower.
The next thing to keep in mind is when you invest in index funds, many times those index funds can pay dividends. Now, dividends are profits that a company pays to its shareholders. So if your index fund has companies that it invests in that pays dividends, you get to collect dividends just by owning that index fund.
And this is another great benefit of owning index funds. These dividends are paid out on a quarterly basis most of the time. So if you are counting on income from your investments, investing in index funds is another way to get that income. The next thing to keep in mind is that index funds are more tax efficient than actively managed mutual funds. This is because actively managed mutual funds do a lot of buying and selling, and sometimes those transactions will incur a capital gains tax, and that tax is passed on to the owner of that actively managed mutual fund. On the other hand, index funds do not do as much buying and selling as actively managed mutual funds, and so your taxes are much lower on index fund investments.
So the last point that we have about index funds is that when you invest in an index fund, that index fund is typically going to be capitalization weighted, which means that when these index funds invest in a ton of different companies, they're not investing in all of the same companies at the same percentage. You're not getting 1% of something, 1% of another thing, 1% of another thing.
They're not all equal.
They're not all equal. So these companies that they invest in, the companies that make up more of the stock market, if they have a larger capitalization or value in the stock market, they're going to have a higher percentage owned in a particular fund.
And this is a very important point because when you invest in an index fund that is capitalization weighted, you are investing more of your money in the bigger companies. So if you hold an index fund that tracks the total stock market, you are gonna own more technology companies because those companies are the most valuable companies on the stock market. You're gonna own a lot of Amazon, a lot of Apple, a lot of Facebook because these are the biggest companies. The smaller companies that are within your index fund, you're gonna own minuscule pieces of them. So if you ever see your index fund drop significantly, look at the bigger companies that are made up in that index fund because more than likely those big companies have also had a drop in the stock market on that same day. This is all really important, and this is something that you should be aware of when you're investing in index funds, is that you are investing more of your money in the biggest companies that make up the stock market.
So that is our insight for you on investing in index funds. If you want to learn more about investing in index funds or just investing in general for financial independence and retiring early, make sure that you check out our stock market investing course. We'll leave a link for that course in the description below, or you can go to ourrichjourney.com to find out more. But of course, if you like this video and you want to see more videos like this, make sure you give us a thumbs up, subscribe to our channel, and join the journey.